G'day, welcome to Lunch Money, your online and social media home for workouts, special situations and capital raising professionals. My name's Nick Samios. I'm the fund manager and director here at Hermes Capital, and I am the host of Lunch Money. Today, firstly, thank you very much for joining us live on Monday. We've made the switch from Fridays. Fridays are for lunching now. Now that we're all allowed out of the office, and I'll be traveling to Melbourne next week, so it's all very exciting. Today we are going to talk about the trials and tribulations of one Ferrari Lusso. What is a Ferrari Lusso, you may ask? Well, it's a car that looks like this. That's it. So it is a Ferrari there in the showroom. I'm told it goes very fast. It was recently sold, and it's a very interesting story because there were various parties and people that thought they had claim to this Lusso. And as a lender, or if you're in corporate restructuring and you're in the business of getting your hands on assets and selling them, I think there's some cautionary tales in here to be told by our two guests who were fundamental to the sale of this vehicle, Ian Hyman and Richard Rohrt. And I'm going to bring them both on right now. Okay, g'day, gentlemen.
Good morning, Nicholas.
We'll start with you, Ian, just very quickly. You've been quite busy. Ian Hyman is the managing director of Hymans Asset Management. So what is it? Is it valuations? Is it auctions? What's the go?
Well, mate, if you can get assets to sell, that's absolutely the place to be. But valuations are our mainstay, and at the moment it's crazy out there. So property side, the development market is as hot as I've ever seen it. Land subdivisions are huge. Asset prices are still very, very strong, although in some areas they're starting to taper off a little bit as supply and demand and the supply. Some of the supply chain issues are easing slightly. I don't want to overdo that, but in some cases slightly. So some of the motor vehicle prices we've seen in some brands are going to probably start just coming back a little bit to the market over the next sort of 3 to 6 months. And maybe in the longer term, obviously, for the more prominent brands like Toyota, which are still incredibly hard to get at the current time.
Okay, so it's mainly private lenders instructing you for property vals. That's the main game. That's the bread and butter at the moment.
Look, I think it is. We focus on the non-bank lending market because they're so much more flexible. Your relationship as a valuer with the lender is much more of a partnership than with the major financial institutions, just by virtue of size. So from our point of view, we see ourselves as basic consultant valuers. We want to be part of the team and to give you the best advice. So the only way we can do that is if we can talk to the right people. In the non-bank lending space, we can do that.
All right. Well, the good news is, Ian, that both of us can physically travel to Melbourne, so we can actually sit across a real desk, not a virtual desk, with Richard Rohrt. How are you going, Richard? What's it like? What's it like down there the last week?
It's just a relief to starting to open up again. My youngest son is a first year, or just completed his first year as a dentist in Wangaratta, and he's been able to come to Melbourne this weekend. So and I had breakfast with him this morning. I was 65 during the week, and we even managed to go out for dinner on Friday night.
Oh, that's fantastic. That is fantastic.
Yeah.
Oh, that is a good story. Now, listen, Richard, you are a partner at Hamilton Murphy. You are corporate and personal insolvency and restructuring advisor. Obviously, the whole corporate restructuring market's been fairly quiet, but what are you seeing much? What's the nature of inquiry that you're getting at the moment?
Mostly in hospitality, Nick. The hard reality for anybody in hospitality is simply that they haven't been able to trade for the better part of 2 years. They've no doubt had some rent relief. They've certainly all had government assistance and federal government assistance, but I don't know really whether or not that sort of assistance, which has already soaked up the available funds, is going to be sufficient to keep hospitality fit and well over the next 12 months. The next 12 months will certainly be a cornerstone as to who's fit enough to be able to reopen and trade and pay off old debts. And it's going to be very, very, very difficult for anybody in hospitality at all.
I guess it's interesting because I know the last time I was in Melbourne, it was after the first major lockdowns, and even then you'd walk down to Grave Street and a lot of the cafes were closed seemingly for good. But of course, if someone's closed, that gives an opportunity to someone else to open up, I guess. But is most of the inquiry you're getting in the hospo space, is it people that are just looking to throw in the keys and walk away, or are they looking to find ways of licking their wounds and keep going?
They're all of the opinion that Christmas this year won't be a saviour, and they really don't think that they're going to be able to survive beyond Christmas. And directors say that they already owe so much in employee entitlement. The real practical problem, Nick, because all businesses that have survived, be it an office, be it anybody who employs anybody full time, nobody's really been able to take annual leave. And all of that annual leave is really going to fall due basically on Christmas Eve. And every business is going to have a real cash flow issue as to how they're going to be able to pay annual leave to so many staff when they've not been able to trade for such a long time. They won't have the money in the bank.
Okay, well, that's interesting. Our friends at FEG must be sharpening their pencils and getting ready for all that. All right, listen, let's. Who wants to start us off? Well, will you start us off, Richard? Tell us about this Ferrari Lusso. You came to. Initially, didn't think it was yours. It was part of an insolvency.
Yes. I was appointed administrator by the secured creditor on about the 20th of December 2019. And we knew that one of the obligations of the company was to pay monthly funds to the financier, which was BMW Finance, each month. We couldn't find the Ferrari. We didn't get any real assistance as to the whereabouts of the Ferrari. So in about February 2020, we issued a notice of disclaimer to BMW Finance to relieve me as the administrator from making any further payments on it, on the basis that it probably didn't have any equity.
Okay, so just to sort of dumb that down for simple financiers like me, for example, you're the administrator of a company. You've identified that somewhere there's a Ferrari. It could be worth a bit of money, but it's under finance to BMW. You've got monthly payments to BMW for this car, and you've looked at it and you've gone, you know what, this car seemingly owes BMW a lot more than what it's worth. I don't want anything to do with it. So you've disclaimed it.
Yeah, I think at the time we thought that the Ferrari was probably worth about $400,000, and the administrator really has to make a call if there's equity in a motor vehicle or any asset. He will pay the monthly obligations, repossess the asset, and sell it, and whatever equity is left in that asset, or be it motor vehicle or anything else, becomes available for the benefit of creditors to receive a dividend. But that only works if you're looking at any asset with a positive equity. If you're looking at an asset with negative equity, in other words, the payout is greater than what the asset is worth, administrators and liquidators will disclaim the asset, saying to the financier, I'm handing it back to you, it's all yours, you go and find it, but I don't have any financial interest in it. Because if there's negative equity, if we take possession of it and auction it or dispose of it, the administrator or liquidator would be on the hook for those monthly payments, and he could assume liability for any shortfall. So administrators and liquidators always look for positive equity in an asset for which they'll sell themselves and provide the surplus funds to creditors. If there's negative equity, administrators and liquidators issue what's called a notice of disclaimer and hand it back to the financier and say, it's all yours, which was
I guess otherwise you're using funds that could go to the creditors, so they get a little bit of a distribution to pay for an asset that there's no joint. And I'm just curious, years and years ago, I mean, Chris Wykes is involved in this story, to tell you how long ago it was. I remember that we were involved in a matter and there was a bunch of trucks, and the trucks were under finance at St. George Bank, and then the trucks got stolen before Chris was able to disclaim them. And then they reappeared. They reappeared up at Razorback Ridge or something, and Chris told the bank, "Listen, we found the trucks. They're up at Razorback Ridge. They're your problem." I was talking to someone the other day, a financier, who they stick tracking devices in these trucks. Are you seeing much of that these days, or when you're involved?
Look, it's certainly been looked at by a number of funders, and there are a number of companies that provide that service. The big issue is that obviously it is not impossible to remove these trackers, and whilst at the point that they disconnect, you will see, or the person that's monitoring them will see where that is. Once the truck, which is on wheels, is moved, then you've lost the ability to find it again at some point in the future. So we've advised a couple of funders that we work for that the benefits really do outweigh, the cost do outweigh the benefits, in the sense that anyone who's devious enough to remove the trackers, they'll move the truck as well. So by the time you get there, you won't know, you won't know where it is.
Okay. All right. Well, then the next thing. So then, Richard, you at this point in time, you think that the car is under finance to BMW. You've got no interest in it. Is the next thing that happens that you somehow find out that BMW have maybe their paperwork wasn't too spot on?
Yes, we did, and it was quite accidental. In May, given that we were appointed in December 2019, last year around April or May, for lots of reasons, we made an application to the federal court to issue a warrant on the premises and to seize books and records. And that was the case has actually got widespread publicity, but in many respects, the federal court was not comfortable with me serving a warrant and then seizing a motor vehicle that I'd previously disclaimed.
But you'd somehow accidentally found out that how did you find out that BMW's security was no good? What did they muck up a serial number, or they just failed to register?
Yeah, they did there. Certainly that wasn't at the time. At the time, we did, when we served the warrant in April or May last year, we still didn't know the whereabouts of the Ferrari. We didn't know what colour it was. We didn't know anything about it. But as it turned out, the director of the company came back to the premises as we were closing the premises back down that night and rechanging the locks that we had effectively broken to have access to the premises to execute the warrant. And it really turned on whether or not I'd executed the warrant in order to seize an asset, which was the car, after I had already disclaimed it and said it's not mine.
Yeah.
And it was only after that we discovered that the registration on the PPSR, the register, appeared to be faulty.
Right.
And it really turned on whether or not I had executed a warrant in order to seize a Ferrari after I turned around and said, I have no interest in it and I've disclaimed it. Then the legal argument was, well, if BMW's registration for its security over the car was faulty, what happens to the car? And the financier took a position, well, if the registration was faulty, they owned the car. And my position was, well, the financier can never own a car. The financier's position can never be greater than simply having security over the vehicle. And if it's unsecured, what will happen to the car? Is the car property of the company? The financier said that they own it, which I don't think any financier can own an asset. The best that they can have is security over the asset. And as things turned out, in fact, on the 13th of May last year, the federal court held that BMW's security was in fact faulty, and it remained an asset of the trust.
Okay, well, before you go into that, I mean, the thing is, the PPSR, the Personal Property Security Register, it is hard and fast. If you've got digits in the wrong place and you don't register it correctly, you're gone. Are you seeing much of that sort of thing, Ian? Are you, where you're acting for financiers one way or the other?
It's not rampant, but it's not unusual. So we probably see it once or twice a quarter. And ironically, it's generally one of the major financial institutions that has, and I classify BMW as one of those, but also the banks, a number of banks over time. And that's why, in many cases, liquidators actually want to take possession of the leased assets so that we can check the VIN numbers, etc., and ensure that they do match up to the PPSR register, because when you least expect it, particularly in an official liquidation where you've got very little in the way of assets, that could be the way that A, you get paid, and B, you can make a distribution to creditors as part of the process. Yeah.
Okay. All right. And then, Richard, so then it was, without getting too deep into the sort of legalities, so then it turns out that you think that the ownership's reverted to a company that you're in control of at this point?
At that point, Justice Anderson in the federal court said that the Ferrari was an asset of the trust and property of the trust. But I was only, at that point, liquidator of the company that acted as trustee of the trust.
Yep.
So we still needed orders to be made that the liquidator of the corporate company, myself, had the legal right to sell assets of the trust. So we made an application to the federal court to be appointed by the court as receivers and managers of the trust. And that happened about a week later.
Okay, so okay, because there's always that complication. Now, then there was another financier, that sort of stepped in and out. Well, yeah, there was another secured creditor, not BMW, but somebody else.
Yes, there was certainly there was originally the original secured creditor, and I was appointed as administrator by the original secured creditor.
Right.
And his loan was eventually discharged pretty recently by the director, pursuant to personal guarantees.
Yeah.
And to some degree now, the director claims that she's subrogated to stand in the shoes of the secured creditor.
Yeah.
And that might mean that the proceeds of the car might become, because a car is a fixed asset and subject to a fixed charge.
Yeah.
And if that's the case, the proceeds of the car still might follow through to the secured creditor, which is now the person that's paid out the secured creditor's debt.
Yeah, I understand. So if you're a borrower or if you're a guarantor, and there's some sort of issue with the loan, the guarantor pays the loan out on behalf of the borrower, whether or not that borrower, that in this case it could be the borrower's company. The borrower could be a company, and the director is a guarantor, and they've paid out that company debt. Then they are entitled, in some circumstances, to subrogate or to step into the shoes of the financier. So whatever rights the financier had that the guarantor personally took care of, they go, well, I've taken over your debt. I haven't paid it out effectively. They're saying I've taken it over, I suppose. And I guess there has to be certain circumstances for that to be live. Okay, so eventually the car. Tell us a little bit about the auction process for this car, Ian. I mean, used car prices have been, escalating. I've heard stories of dealers of used car dealers hanging on to stock because they're almost hanging on to stock just because it's going to be worth more tomorrow than it was yesterday. So talk us through that.
I'm not aware of dealers hanging on to stock, but there are certain brands that have definitely, where supply has been significantly short of the current demand, particularly in the trading market. So where we've had a distortion, apart from all the global supply chain issues that everyone's heard about, you've also had this instant asset write-off, which very conveniently allows any tradie, for example, to go out and buy a new car and write it off immediately for tax purposes. So you've had this incredible increase in demand for four-wheel drives and utes, and that to a large extent is probably the equivalent of some of the supply chain issues we're also experiencing out of places like Japan and the US. So it's a really interesting conundrum. I think we're seeing that some of that demand is now being satisfied. The instant asset write-off has now been around for over 12 months, and therefore most people that are intending to buy a new vehicle who may not have been in the market traditionally have now been satisfied. But we still have significant demand, particularly for Toyota. If you go to the prestige brands, in most cases, short of the normal waiting list you'd expect, if there is one, they're pretty much available, now as we speak. So if you're looking for a new Jag or a higher level Mercedes-Benz, you can unless you want to customize it, and that's a different ballgame. But if you're just looking at something off the shelf, you can probably get to a dealer, or certainly find a dealer around the country that can supply that vehicle for you.
Well, yeah. Look, we won't dive too much into that. I will make the observation that I've been looking to buy a used car, and and I got this alert, from car sales to say that there's a car that I'm interested in has become available. It's a brand new car, and so they're now flogging the brand new cars, and the brand new cars are only marginally dearer than the used ones. And when I rang the dealer, they seem to be keen to do a deal. I didn't even ask for a deal, and the guy's going, we can do a deal. But so there might be some deflationary pressures there, and we'll come to that a little bit later on. But just tell us about some of the special challenges in selling a car like a Ferrari Lusso.
Well, look, we partner with Mannheim in a number of areas, and certainly the prestige car side of it, we do. They run a weekly prestige car sale. So we basically did the marketing for the vehicle and worked within their online system. And look, we thought the time that the vehicle was valued, it was just about the time that Ferrari announced the discontinuance of this model. We're still not sure, what impact that has had. But we knew it was going to be worth somewhere between $300,000 and $400,000 in that area. It's ended up selling for just under $360,000, including the buyer's premium. So it's still for a 4-year-old vehicle that's now been discontinued. The fact that there are only 10 or 11 sold in Australia, only 300 sold worldwide, it never really took off. And one of the things I think really was a mark against this vehicle was the big blue stripe down the middle of the vehicle, which I think would have probably put off quite a few people. It's not what I would consider to be your traditional Ferrari. It's a bit of a showy, glitzy sort of a car. It's got a lot of punch. It's a beautiful piece of machinery, as only the Italians.
Sort of painted like a Ford Falcon there, isn't it?
Yeah, look, you could be cynical and sort of suggest that they knocked off the Ford. No, I wouldn't do that. It's certainly, if you like that sort of thing, it's fantastic. But I spoke to a number of buyers, and they were put off by the blue stripe, and obviously you wouldn't remove it. That would absolutely affect the value of the vehicle. But look, we had something like 20 different buyers on the vehicle through the bidding process, which is for any vehicle at an auction sale is substantial. And then we had a couple of bidders fighting out over the last sort of $20,000. I had quite a few calls after the sale, and it did take some time. Richard hasn't got into the final hurdles we experienced in actually selling the car. there was another hurdle on top of that where the director obviously put a claim over the vehicle after having stood in the shoes of the original secured creditor. But once that clearance came through, the vehicle's just recently been paid, and I'm anxiously hoping that early next week we'll be able to send the funds to Richard.
I do have another question for Richard, but before I get to that, we have received a cheeky question on LinkedIn from Darren Anderson, and it just reminds me that we're giving away a couple of books, a couple of Mike House books for good questions. And please let there be a better question than Darren Anderson's question, which was: is there any truth to the rumor? Is there any truth to the rumor that a certain insolvency practitioner purchased a Ferrari to add to his collection? People who are watching this live on LinkedIn will be able to read that comment. But
I can say unequivocally that no insolvency practitioners bid on this motor car.
Okay, excellent. Just very quickly, if we could just quickly show those books again. So Mike House was a great guest about a month or so ago, and these books are fantastic. I've got a couple of copies myself, and the way they're illustrated and the way they tell the story is really fabulous. So Richard, this when you told me the story originally, you disclaimed the asset. We've been through that process, but then you've reclaimed it. Is that a common thing, or I've never heard of that before? Is that something that's ever happened before?
It's very, very interesting, Nick, because it's very, very well known in the insolvency industry that you can undisclaim an asset that you've already disclaimed. But I thought it was actually quite easy and quite common. But that's a fascinating thing about insolvency. You still learn something. Well, I used to learn something and take it home every day. At this stage of my life, I probably learned something new and take it home about once a fortnight. And I was surprised that as much as liquidators have the right to undisclaim an asset that they've previously disclaimed, actually how rare it was. And solicitors on both sides really had trouble coming up with case law. So in some respects, it really made new law in the federal court. So
you've now been immortalised in case law. You're a precedent.
Yes.
Very good. I have had lawyers try to use me as a precedent. So please don't. I don't want to become a precedent, please.
No.
Okay.
But Nick, the actual sale of the car during COVID presented its whole brand new world of problems. How do you sell I mean, we're not selling a Commodore or a Falcon. How do you sell an exclusive car like a Ferrari during COVID? And poor Ian Hyman was tearing his hair out because Sydney went into lockdown, and that's where the car was based. And nobody could see the car. Nobody could walk around it. Maybe you guys can tell me why, if the bloke's looking at a car, we always have to open the bonnet. And we have to walk around and we have to open the bonnet. I don't, from my point of view, I have no idea why I open a bonnet. I go, oh yeah, there's an engine there. That's good. But what do all blokes look at when we open a bonnet? I've got no idea.
Yeah, no. I'm selling a car, so that, and a guy came to look at it and he said, "Can you pop the bonnet?" Oh, bloody hell! How do I do that? And I think it's a set. So I've had the car for 3 years. I've seen under the hood twice. Darren Anderson makes the comment: you can only undisclaim it if someone else has not relied on your disclaimer to their detriment. But I guess that didn't happen in this case. But I was going to say that go on.
But we couldn't sell the car in Sydney because everything was in lockdown. Yeah. So Ian, you should mention we tried to sell. In fact, we tried to transport the car to Brisbane. And then we looked at transporting the car from Sydney to Melbourne so that people could walk around the car for cities that weren't in lockdown and be able to ask to pop the bonnet and have a look and double check that there's an engine in there or that it's got a dipstick or a radiator cap. God knows why blokes always. Yeah. I'm the same. I have no idea why, if I was going to buy a car, why I would want to pop the bonnet. I don't know what I'd expect to find. I don't know.
I don't think I've test driven a car. I've bought lots of cars. I don't even test drive the bloody things. But listen, Richard, one of the things that insolvency practitioners have in common with people such as myself is you need to learn to catch the third spear. I don't know if you've ever heard this one before, but someone, as an insolvency practitioner, someone throws a spear at you and you catch it in the left hand, and then they throw another spear at you and you catch it in the right hand. It's that third spear that you got to be able to catch when your hands are full with the first two. Is that so? That's probably a fair observation. Now, there was a final sting in the tail with this one, or was there a third spear?
To some degree, there is, but
if you can't talk about it, you can't talk about it.
No, yeah, we're still negotiating different matters with the director. I think it would be wise that everybody kept that to themselves. But
okay,
there could be a third spear.
Okay. Now, Ian, so were you happy with, in the end, you were happy with the result?
Look, I think so. I mean, we ended up moving it to Melbourne. Of course, then Melbourne subsequently went into lockdown, which happened very quickly. If you recall, it looked like they had very low cases down there, and they might be able to avoid that. But unfortunately, we got it there within a week from recollection. The lockdown occurred, so we decided to proceed on the basis that we had taken a lot of footage of the car. We had 360-degree sort of photographic evidence in very high resolution. We had full mechanical reports prepared. The car had been, thanks to Richard's diligence, he had made sure that the car was serviced during his ownership period, which needed to happen. So the logbooks are up to date. The car was in immaculate condition, only having travelled 16,000 kilometres, not including the trip to Melbourne. Obviously, that was done on a car carrier. But look, personally, I was fairly pleased with certainly the interest that the car generated. On the pricing side, there's never been one to auction in Australia. It's about a $600,000 car, roughly new. So 4 years old, with and a little bit unusual, only 10 or 11 in Australia. So you could say that might have to give a collectible. I thought maybe it'd become a collectible, and it may still do in the next 10 or 15 or 20 years. But the reality is that we've achieved, after 4 years, about a bit over half of its replacement cost.
Okay. All right. Well, look, it sounds like the epilogue to that story is yet to be told, and we'll leave that for another day. Look, I just wanted to quickly get your thoughts on some of the new. Sorry, Richard. On
the Cup. Do you want to talk about the Melbourne Cup tomorrow?
Well, I'll tell you, we'll finish up with that. We'll get your tip on that last. But the first, of course, Melbourne Cup Day is famous for the Reserve Bank setting interest rates. And so I just want to go to slide 2, and I want to show you this news headline. Terry McCrann, the real interest rate race starts on Cup Day. Now, I don't think that anyone's expecting the Reserve Bank to lift interest rates tomorrow, but some pundits are saying that there's 3 rate rises factored into the markets already next year, right? So 2022. We're talking about rate rises, not 23 or 24. The reason for that is slide 3. Depending on who you listen to and who you believe, we do have inflation. Pressures mount on central banks as inflation expectations surge. Now, we're all experiencing inflation anecdotally. There are some economists, of course, who deny that it's ever going to happen and that money printing can be done with impunity. Now, what's interesting when you combine these interest rate rise, the trouble is, how does the Reserve Bank battle inflation? I mean, when I was a lad studying economics at school, if there was inflation, the Reserve Bank, the government, the interest rates would go up and that'd temper the inflation. And we were talking a little bit earlier, Richard, about, the recession that we had to have with Paul Keating and the effervescent economy and interest rates going up then. But now we've got the slide 4. We had Chris Joy, who is a highly respected journo there at the AFR. He's also a fund manager himself. And I've got to say that Chris is normally bullish. So when everybody else says that prices are going to go down, Chris is normally the one that says, no, house prices are going to go up. Now, he said that if interest rates go up, and I think that his maths was done on a 1% increase in rates. I'd have to double check. But if interest rates go up, we could see house prices fall as much as 20%. Now, I just wanted to get your thoughts on that, Ian. How are you sort of taking all of this in? How does it affect valuations?
Look, I think interest rates are really put us in a very difficult position over the next 1 to 2 years. Certainly as valuers, the challenge for us is to ensure that when the correction comes, and it's going to be, and I believe it'll be substantial, that we're not held there with a stack of valuations which lenders try to sheet back to the valuers, not just us, but all the major valuation firms. We did say after the GFC that a number of banks in particular decided to tackle their valuers based on valuations that had been done prior to the GFC, and as a result, there were a number of court actions. Banks actually lost a number of those cases because the market before the GFC was obviously vastly different to the market after the GFC, and I think we're going to see that again. We're constantly saying to the lenders that we value for, both on the not just the property side, but also P&E. Those people that are even on the plant and equipment side that are lending now, if they're funding used equipment in particular, there's a real chance that in 1, 2, 3 years' time, that you won't have just the normal depreciation on when you sell those assets. If you need to repossess them, it could be another 30% more, because in some cases values have gone up by 30% in this period, and that's what the funders are funding on. So for the first time ever in the transport area, we sold some trucks just recently where 2 of the major banks refused to fund the purchases, even though they've been purchased at auction, on the basis that they were above market value. And what they're trying to say is that basically you've just sold some older trucks that are actually almost in line with new price, and we're not prepared to take that extra risk of the exposure if you can't complete on this finance transaction in 4 years' time. So that's the first time that I've seen that, in this current sort of environment during the GFC. And I think we're going to start to see a lot more of that. On the property side, there's no hint yet of the non-bank lending sector pulling back. It's still full charge, get as much money out there as possible. But in many cases, they're also lending on lending private investors' money. So the private investors have literally got very few places to plump that money. There's huge amounts of cash around at the moment. The proliferation of family offices has gone through the roof. So
well, the thing is, there was an article, I think today, there was some speculation that because there is this expectation that interest rates are going to go up, people are the old fear of missing out, and people may be buying now so they can lock in their rates. Well, I was talking earlier, Richard, certainly we're all old enough to remember the recession we had to have, and that was a time when there was high interest rates. There was certainly inflation, although I think they finally managed to kill it off when the interest rates were so high. But that were, I guess a couple of things that are holding back corporate, the restructures and the VAs and the insolvencies at the moment is, as Ian just pointed out, there is so much super cheap money around, and it's readily available. The other thing is, if you've got high asset prices, then people are able to borrow against those asset prices rather than restructure their businesses. They can get their hands on money and sort of go back to the casino table and have another punt. I mean, what do you think?
A couple of things. Ian's quite right when he says banks are rejecting money on the basis that somebody's paid too much for an asset. I think we are seeing a real change in bank lending, where banks for the last 25 years have lent on equity. They've lent on security, not on ability to necessarily repay. And I think the old-fashioned way of banking is now coming back to the fore, where banks will no longer just lend on security. They are going to lend on ability to pay, which is what they should have always done. But for 25 years, they've lent on security and not been all that interested on ability to repay the loan on a monthly basis. I think the banks are turning back the clock to the way that they used to bank in the 1980s. But equally, I completely disagree with the Financial Review article that a rise in interest rates may see house prices plummet 20%. Was it Nick Coombs?
Oh, Bill Coote. That was Bill Coote up in Queensland. Yeah, Bill
Oh,
Coote.
right.
said,
I agree with
they
you,
don't
Bill.
often go down.
No, and I agree completely with Bill. There is a pendulum, a seesaw,
Yeah.
and blokes with grey hair all know about the seesaw.
Or no hair.
My two sons are looking for an increase in interest rates on the basis that that will enable them to see a fall in housing and be able to buy a house together.
Yeah.
I don't think that is ever going to happen. The pendulum between the stock market and the housing market. If interest rates are really low, stock market is always really high. And that's the way it's been for 1,000 years. Nothing ever changes it. If we have inflation and you can get, instead of getting 1% interest at a bank, we can get 3% or 4% or 5%, investing in the stock market becomes less and less and less attractive. The higher the interest rate, the lower the share market. And when you sell out of the shares, you've got to put your money somewhere else and you put it in housing.
Yeah, well, certainly the crash of '87, we're going a long way back there, but, people expected the property market to collapse as well. But of course, all the money came out of the stock market, as you say,
Correct.
and went into the property market. Now, that said, the property market did come off in the early 90s. There's no doubt about that. But I guess, arguably it wasn't for long. But in that recession, there was the term jingle mail. Where the mail that the bankers received was jingling because it had keys in it. People were just giving up. But we do live in extraordinary times. We are kind of out of time. So I will ask you both. Now, Richard, you've got a tip for the Melbourne Cup, do you?
I take two things. If I looks as though I haven't had a shave today, you're quite right. I'm trying to get a jump on some mates for the month of November.
Right.
So I'm unshaven in the interest of charity. And equally, in the cup, I take a first four every year. I'm sick and tired of getting 3 legs in and not 4. So I think the horse to beat is Incentivise, which is going to start 2-1, 3-1, and is incredibly short for a Melbourne Cup. So I don't think anybody can go past number 2, Incentivise. But for a first 4, 2, 4, 21 and 24. And if 2, 4, 21 and 24 get up, I won't be coming to work next week because it'll probably pay about 40 grand.
Very good. Very good. All right. Well, I might have a lash at that myself with you, Ian. Ian, I know that.
I'm just a lover of horses, Nick. So I wouldn't insult people by giving them a tip on the Melbourne Cup. But I just want to finish off. I think what Richard said regarding where the share market and property and the balance. But I think what defined the recession of the 80s and 90s is that, unfortunately, when the property market boomed and rates continued to rise, eventually, and the market did fall quite substantially, we did see that very, very strong recession that lasted for a number of years. And whilst the price always does come back, I would say whether it's in 2 years, 3 years, or 4 years, it might even be 5 years out, there is going to be a significant short-term correction, which will hurt a lot of people. And unless the Reserve Bank has worked out some new ways of injecting money in the economy without driving inflation, I just don't see any way of avoiding that. So I do predict a significant short-term adjustment, but in sort of 3 to 5 year timeline.
Okay. Ian, if I just jumped in, I don't reckon if you buy in the medium price band of a suburb, I don't think those prices come back. But if the medium price band in a suburb is, say, $800,000, if you pay 1.4 million for the house, I think when you're up in the most expensive houses in any given suburb, they come back. But I don't think in that medium price band, I don't think those prices really ever fall. The ones that pay for the most expensive house in a suburb, they always have problems with rising interest rates and home loan rates. But then again, think back to the late 80s when the government put a cap on home loan rates at 16%. If you're already an existing borrower, your financial institution couldn't charge you more than 16%. But there were still homeowners getting into the market paying 17, 18, 18.5%. And those prices in those suburbs continue to rise. But you never want to have the most expensive house in a postcode. So long as you're in the median band, I don't think those prices ever fall.
Sure.
Okay. All right. Well, Richard Rohrt from Hamilton Murphy in Melbourne, thank you very, very much for your debut on Lunch Money. It was delayed, but it's fantastic. I really appreciate you making the effort to share with us your wisdom and experience. Thank you very much, Ian, for once again. I don't know if this is your third or fourth appearance, but thank you very much for sharing your experience and wisdom, and always very interesting to hear what you have to say both about property and equipment prices. We're going to wrap it up. Thank you very much to those of you who have been watching live. The good news is that our staff are back in the office. So if I owe you a Lunch Money mug, the Lunch Money mug is on its way to you. Darren Anderson, the book collection is on its way to you as well. And if you're listening to this on a podcast, or if you're watching it later, do us a favor, share, like, or subscribe so that you get a notification the next time we go live. Thank you very much. See you in a couple of weeks when we do it all again. Cheers.